Morning and welcome to the latest of the IMAP webinar series. This is the first of our webinars coming to you in a truly virtual environment, and I hope that all of you who are attending this are safe and well at home. These are troubled times for all of us, and we're all learning a new set of operating models. Today is a really interesting session, and that's evidenced by the large number of people who've registered to attend today's session. My name's Toby Potter. I'm the chair of IMAP, and we're joined today by Tim Wong from Morningstar and Trent Koch from Sentier. I'll introduce both Tim and Trent as we get closer to the presenting today's webinar on real assets and infrastructure. But before we start today, a couple of points I wanted to make. How IMAP is addressing the COVID situation and what we've done to move our events from live to virtual. Webinars have always been a key vehicle for us, but now we're moving our roadshow, which was to have been held in Brisbane, Sydney, and Melbourne in March and April, to a virtual event. We were lucky enough to hold the Brisbane session in late March before we all ended up in a no more than 2 people in a room situation. But now we're moving the roadshow to 4 one-hour sessions to be held starting on the 20th, 21st, 22nd, and 23rd of April. We're taking the content from the roadshow and packaging it into one-hour sessions. Those of you who registered to attend the roadshow in each centre will have received an invitation to register for that. And as a small gesture, we're sending you a lunch voucher as well from Uber. I'm looking forward to that. I've seen the material in Brisbane, and the topic for the roadshow is professionalisation. What does it mean for advice businesses? And I know you'll get a lot out of it. We'll be promoting that through the next couple of EDMs that we send. I'm going to talk about the awards in a moment, but just just to mention also our portfolio management conference, which we hold in August. We've moved to November because we want to be certain that we're able to present that as a live event. And we moved our Investec technology conference from November through to back to September to prevent a clash. The next webinar we'll be running on the 29th of April, we'll have Lonsec talking about alternatives and their use in managed accounts, and I know that'll be popular. Before I move on and talk about the awards, though, I want to talk a little about the community of interest groups that we run. These continue to operate. The first of those is our portfolio management group. The thing which managed accounts have done is created an entire group of portfolio managers and researchers and analysts now who are primarily focused on developing and managing managed account portfolios. In many cases, these are people out of research houses and the research function within advice businesses who've moved up in terms of their importance and role. We've tried to draw that group together in our portfolio management group, and if you think that that's relevant for you, I'd invite you to drop us a note. For those who are responsible for the management of portfolios that end up as licensee managed accounts. The next session for that group, a virtual session like this, but a more interactive one, is on the way ETFs have responded to market volatility. The way ETFs have responded to market volatility, and we'll be managing that. We'll be presenting that session together with iShares. In fact, one of the great things which these virtual webinars have enabled us to do is to present using people who are located overseas. And BlackRock, one of BlackRock's most senior fixed interest senior managers based in Hong Kong, Darren Wills, is scheduled to present to that group. So the focus of the session will be on ETFs and the effect of volatility on them. The other groups which are continuing to meet within IMAP are our regulatory group, which has had a lot of engagement with ASIC and FASEA in particular. Earlier today, there was a session with FASEA on the way the Code of Ethics will apply, and the Data Standards Group. Now, let me touch briefly on awards. We've delayed the awards this year because we understand that many of you who are involved in managed accounts will be fully occupied with market volatility and in adjusting the operating rhythm. So submissions for that run through to the 26th of June, and the awards themselves will be in August. That gives us an opportunity for the winners to participate in our portfolio management conference in November. I particularly encourage those of you who are involved with licensee-based managed account portfolios to enter. You'll get a lot out of it, and we think that that is the cutting edge of portfolio management in a managed account world. Now, let's move on. Today, our two presenters are firstly Tim Wong from Morningstar. Tim is a director of Morningstar Australasia and responsible for manager research, qualitative manager research, in particular focused on infrastructure. And our second presenter will be Trent Koch from First Sentier. Trent is a portfolio manager for the global listed infrastructure team within First Sentier. Trent has a deep background in the analysis and portfolio management associated with infrastructure and real assets. Through today's session, you'll find at the bottom of your screen a Q&A button. If you have questions, type those in, and they'll appear for the presenters. So now it's my pleasure to hand over to Tim to take us away through real assets and infrastructure. Thanks very much, Tim.
No problems. Thanks, Toby. And I hope everyone's having a good day today. So just want to talk about a few different topics of interest regarding how we think about infrastructure at Morningstar and how it's used, rolling portfolio, income, and some other sort of considerations. So if you could just kind of turn to the next slide, please, Toby. Great. So the first topic I'd like to talk about is how we think about the rolling portfolio of global listed infrastructure. As you can see in that presentation, we really think it's ideally used as part of a sort of a broader real assets exposure or as a defensive equity allocation. There are certainly valid reasons for why we think investors should expect a relatively defensive and less cyclical return profile from the sector. And it comes down to, as the presentation suggests, the sort of cash flows that these assets generate, the relative stability and predictability. And from that, there are several reasons for why you should expect the cash flows to be relatively stable. We are talking about essential services here, like water, gas, electricity. Consumption of these services is going to be relatively steady regardless of the prevailing economic conditions. We're also talking about effective monopolies in some situations, like airports, utilities. There's really no alternative to using the services that these businesses offer. The next point there about regulated regulated earnings and long-term contracts that infrastructures have in place. Everyone's familiar with toll roads and the agreements that infrastructure operators may have with governments to operate assets and charge tolls over a long period of time. And that kind of relates to that last point there about inflation linkages. So we can have infrastructure companies have contracted contracts in place that may have embedded price escalators over a several year period that are agreed in advance. Even on the other side of the other hand, they can have utilities that may be subject to a regulated rate of may be allowed to earn a regulated rate of return that may actually be set as like a real rate of return, and effectively allows for a pass through of inflation in the form of price increases through to consumers. So there are certainly reasons for why you should expect a degree of stability and predictability in the cash flows of these businesses. So if we just turn to the next slide, I guess what we do want to highlight though is that the sector is certainly not immune to drawdowns despite this characteristic. Obviously, we are talking about listed equities here. There's always going to be some degree of sensitivity to broader equity market movements. One can see this over the last decade that the valuation of global listed infrastructure has really appreciated materially alongside the rest of the equity market. No doubt, a big part of that has been increasing earnings, but valuations have also risen, at least until this last sort of period of volatility. And that's certainly coincided with widespread declines in the cost of capital, which has really supported all risky assets, infrastructure included. The next point there about leverage, really just want to highlight that, a reminder that leverage is really a critical factor that can amplify the volatility of earnings that equity holders end up receiving. There's really nothing complicated here. Obviously, debt increases the scope for both gains and losses. Now, listed infrastructure companies typically carry higher levels of debt than other equities. In terms of the portfolios we qualitatively rate, we sort of see debt to total capital ratios in the order of sort of 50 to 60%, which compares to about 40% for equities more broadly. There are certainly reasons for why this is done. I mean, there are, as mentioned before, the cash flows that these assets generate are generally relatively stable, and leverage allows equity investors to generate high rates of return on their capital invested. And most of the time, this isn't a problem. For the most of the past decade, infrastructure investors have really enjoyed very healthy total returns amid quite benign financial conditions. I guess what I really want to note, though, is that even over that period, leverage has been an intermittent source of stress. Obviously, no one needs any reminder of what happened in 2008-9. But debt servicing has come into focus at other times when questions about cash flows generation have emerged. We saw that in 2014-15 when oil and gas prices collapsed, and that affected several energy pipeline operators. And obviously in the current global stoppage where we're all experiencing, there's been significantly reduced demand for transportation services that are operated in the form of airports and toll roads. Now, the current situation is obviously unprecedented, but it does kind of highlight that next point about heterogeneous assets. The sector spans some very, very different types of assets. We can talk about utilities, toll roads, airports, pipelines, mobile towers, railways, and you can imagine that these assets have very different risk characteristics. Obviously, a regulated utility may be much less sensitive to fluctuations in the broader economic cycle than an airport, or similarly, oil and gas price movements may affect the capital expenditure plans and dividend plans for, say, energy pipelines. I guess importantly, the infrastructure managers we cover all really do try to limit their portfolio sensitivity to sort of competition and movements in commodity prices, but their tolerances ultimately vary. And that means that the investment universes and consequent portfolios that they run also are different. So it's really important in our view to understand what each strategy brings to the table and really be thoughtful about how it may or may not actually complement your own portfolio. So we just turn to the next slide, please. And here, all I'd really want to just highlight here is how declines in global listed infrastructure have tended to coincide with broader equity market falls, equities as represented by that blue bar. We have shown a couple of different infrastructure indices. I just note that we didn't have data available for the FTSE 50/50 index back in 2008-9. I guess now what I just want to make clear is that I'm not saying that infrastructure has no portfolio role. I mean, certainly we've seen over several years that the sector has delivered returns with less volatility through the cycle than other equities. But I just want to stress that you should really be fully aware of both what it offers and the potential pitfalls. So if you just turn to the next slide, please. I'm just going to spend a bit of time talking about the income side of things. And as noted there in the presentation, the one thing I'd really like to get across is that high dividend yields don't always translate to higher and more consistent income distributions when we're talking about pooled managed funds. There are two particular factors to be mindful of, and they are currency hedging and fund flows. So on the first point with currency hedging, many investors in listed infrastructure tend to use currency hedged options, obviously to limit the impact of currency movements on the returns they earn. I guess one byproduct though is that when there are steep declines in the Australian dollar, that can actually reduce or completely prevent the payment of a scheduled income distribution, because gains and losses on the currency hedge are typically accounted for on a fund's income account. And so large currency hedge losses can offset the dividends and capital gains earned on the underlying holdings. On the other side of the ledger, hefty fund outflows can cause portfolio managers to realize significant capital gains. And those gains are consequently distributed as income. So that can also create, I guess, outsized income distributions. Just that next point there about the franking credits, that's what just want to highlight is that you're not typically going to get a huge amount of franking credits from investing in the sector. So that may be a consideration for those that are thinking about trying to find tax efficient sources of income. So just moving on to the next slide. And here is just mainly just want to show some statistics in terms of how income distributions have played out over the group of portfolios that we cover at Morningstar, dating back to the 2008 financial year. You can clearly see that there have been periods when funds have paid little or even no distribution. That's really clear in that sort of 2009 year and that's when the Australian dollar collapsed significantly. But then there's also been other occasions when income returns have been like well over 10, sometimes even 20% or more. Now, it's important to bear in mind that flows and currency hedges can shift the timing of when income is distributed rather than the aggregate amount. But that could still be a factor for investors who are trying to think about building an income-oriented sort of portfolio. Now, I guess on a sort of a more immediate basis, we have seen the Australian dollar fall pretty significantly since the start of the year. So, there is some risk that I guess the first quarter's income distributions may be affected by that. That said, though, got this thing about TOFA election, which may or may not mean something to you. Now, just want to note here is that an increasing number of managers have made what's known as a taxation of financial arrangements election that essentially prevents currency hedge gains or losses from impacting the income distributions, funds income distributions, because the managers are actually able to account for these gains and losses through their capital account instead. We've certainly seen a this TOFA election being increasingly adopted by an increasing number of infrastructure managers. So it could be the case that the hit to this quarter's income distribution could actually be less severe. That was certainly what we've seen historically. So just moving on to the final slide, just a few points about how Morningstar sort of assesses investment strategies and how it relates to listed infrastructure. So as noted there, we have four main factors. There's nothing too surprising. The investment team, the approach to building a portfolio, this parent standing as a sort of a steward of investors' capital, and how much that fund costs. All these factors are used when we evaluate infrastructure strategies, the same as we do for any other type of capability. I guess specifically with respect to global listed infrastructure, one thing we are a bit more attentive to is making peer relative comparisons, because there are quite a variety of different benchmarks that are employed by fund managers. We've got a range of indices from the likes of S&P and FTSE. There's CPI-based hurdles. So it's harder to just use one single yardstick for assessing how a manager has ultimately fared. That next point there about delivering a differentiated returns path, I think that really reflects what we think how most investors look at the sector and how they use it. Given that we think most investors are looking at the sector as diversified in their portfolio, we try to be particularly attentive to factors such as how well manager can play that role, and looking at things such as how strictly a manager defines their universe. You're looking at what they rule in and out, and the reasons for why that's the case. The infrastructure managers generally measure this differently. They might use a percentage of revenues or an estimate of sort of a business's enterprise value that's involved in sort of allowable infrastructure activities. So we're really mindful of the sort of threshold levels and how their investment universe consequently spins out. It's arguable that a manager that defines a universe more stringently, could be less susceptible to unexpected external factors. But the proof will ultimately lie in whether this is translated into a more stable earnings stream over time. Also think about the extent to which unexpected negative events have affected the portfolio, and ultimately how managers have dealt with these situations. That next point there about risk assessment, that's really critical. Thinking about how managers scrutinize factors such as governance, regulatory factors, and leverage, because these are the sorts of factors that can, lead what are otherwise relatively predictable businesses into trouble. So with that, that's the end of my presentation. So yeah, happy to turn it over to Trent.
All right. Look, thanks very much, Tim. I mean, as I mentioned at the start, there's the opportunity for you to ask questions as you go along. And in fact, one has come in while we've been talking, Tim, which is specific to Morningstar's assessment of managers. Do you look at performance fees and do the maximum performance fees show on information sheets? So I guess the question is, how do you view performance fees in infrastructure funds?
Yeah, so yeah, it's certainly an important consideration. Now, because there are managers that might use like a sort of an equity-based hurdle, or some managers might use a absolute CPI plus X percentage based hurdle as the basis of their performance fee. I think we have for a long time believed that an equity-based hurdle would be more appropriate. There's because we are still talking about listed equities, and the broader equity market movements can play a factor in how a manager performs, that is not fully captured by like a CPI-based hurdle. Obviously looking over time, if managers have tended to earn significant performance fees, seeing whether or not that's genuinely related to performance, or is it more a byproduct of the way they've benchmarked themselves. So that's certainly all thrown into the mix. We have the data points that we monitor in terms of what managers report their performance fee and what they've earned over time. Yeah, and it's definitely an important consideration.
Thanks. Well, now look, it's my pleasure to hand over to Trent Koch from First Sentier. Oops, let me just go back to take us through their view of global listed infrastructure. Over to you, Trent.
Thank you, Toby and Tim, and good afternoon, everybody. So yeah, my name's Trent Koch. I'm a portfolio manager at First Sentier, managing a global listed infrastructure portfolio. We have a team of 9 people managing about $10 billion for our clients. We build a portfolio from the bottom up. It typically has around 40 to 45 companies that we're investing in globally. Those are infrastructure companies in listed markets all over the world. For the presentation today, I thought I'd spend the first 5-6 minutes just talking about what is infrastructure and the role it can play in a portfolio. That was going to be the focus of my presentation, but I think just given the events of the last few weeks and months, I thought I'd spend a bit of time talking more specifically around giving a bit of a market update and what that means for infrastructure investments. So just first slide, thank you, Toby. So firstly, just what is infrastructure? You can see here on this slide, we break the universe down into 4 broad categories. But these are tangible, real assets. You can see and touch them that provide essential services to society. So as Tim mentioned in his presentation, they tend to be either monopoly or duopoly type assets. They either have regulated or long-term contracts in place. And often there's an inflation linkage there as well. Those 4 categories that we break it up into, think of firstly the one on the left there, transport, roads, airports, ports, rail. This has been probably the part of our universe that's been most directly impacted by what we've seen with COVID-19. Utilities, water, gas, electricity, these tend to be regulated assets, make up over half of our universe. Energy, here we're not investing in oil and gas producers, we're investing in the pipelines and the storage companies. They tend to have long-term contracts in place, often with minimal volume risk. And the 4th category there we have is communications. So think of mobile towers and satellites. Again, we're not investing in the telecom company, we're investing in the companies that own the infrastructure behind it. We don't let a benchmark, Tim talked a bit about the different benchmarks that managers have. We don't let a benchmark determine what we consider to be infrastructure. We're looking more at the characteristics of these assets to help us determine our focus list. So we're screening out anything with too much commodity exposure, too much volume risk, competition risk, and really trying to focus on those long-term steady cash flows for our clients. On the next slide, you can see here how the universe has grown over the last 20 odd years. 20 years ago, you had a universe of around $500 billion worth of assets. And if you look there, it was broadly made up of brown and green, which is the utilities. Today, you have a universe that's grown by almost 10% per annum, over $3 trillion worth of opportunities. And now we have those wide range of different types of assets to invest in. So this is one of the reasons why you're seeing infrastructure become a standalone asset class for many investors. On the next slide, just a couple of reasons as to why infrastructure is proving to be of interest to investors. Firstly, the income, and the point there, it's a reliable income. If you look here over the last 20 plus years, you can see that infrastructure has given investors a dividend yield of between around 3 to 4%. That dividend yield today, if you look at that chart on the left, is actually trading higher at around 5%, even a bit more. But I would caution that the numbers here are Bloomberg consensus numbers, and we think there are some downgrades to come to some earnings and even to some dividends. But based on our best case estimates today, you should still only see about a 10, maybe 15% fall in dividends. So that 4% dividend yield is looking still pretty secure from our perspective. And the chart on the right shows payout ratios where they're at today. So with the exception of energy pipelines, where payout ratios are close to 100% for many of the companies, payout ratios on average are more in that 70 to 75% range, suggesting that there's still scope to manage through this event that we're currently in. Next slide talks about structural growth. This is one of the key reasons why we're such long-term believers in this asset class. Yes, we're going through clearly a very an unprecedented and somewhat unique event right now with a demand shock to the economy. But there's a structural growth story that's going to continue to drive the earnings for many of these companies for many years and decades, in fact, to come. The decarbonisation of electricity that's benefiting, utilities such as Nextera, Dominion. The relieving of urban congestions through toll roads or passenger rail networks. Transurban, a company which is obviously familiar to many here in Australia. East Japan Railway, they're the owner of the bullet train in Japan. Transports millions of passengers every day between Tokyo and Osaka and other parts of Japan. Securing low-cost energy. So these are, companies that have a huge network of pipelines that transmit these goods that we're going to continue to use for many years to come. The mobility of communication. If there's been one sector that's actually seen growth in the last few weeks, it's actually been the tower space. You can probably see from my video here that I'm sitting at home today. I've shipped the kids out for a couple of hours so I can be on this call with you all. But I am working from home, as are many people today, and I've set up my home office. I've got internet going. We've got Netflix going downstairs. We've got the mobile usage of people around the world is going up exponentially, and that's another structural growth story that you're seeing for companies such as American Tower and Crown Castle. And then finally, before we get into a bit of a market update, another key reason why investors have chosen to invest in the asset class on the next slide is the lower volatility. Again, looking at data over the last 15 years here, you can see that infrastructure's given investors a return of around about 10% per annum. And it's done that by achieving minimal volatility compared to other parts of the market. So relative to global equities, higher returns with lower volatility. And on average, the statistics and the data that we've seen suggest that you get most of the asset class has been able to capture most of the upside in rising markets, about 80%, but has helped also to protect capital in down markets. I'll talk more specifically as to what's been playing out in recent weeks and months, but that's been the long-term trend for this asset class. So that hopefully just gives you all a little bit of an overview of the types of companies we're investing in. As I say, it's very much a global portfolio, 40 to 45 companies. Today, we have just the 2 Australian companies in the portfolio, so we very much are investing across all markets and looking to provide our clients with diversification by country, by sector, and by regulator. I thought I'd spend the next part of the presentation now just giving you a bit of a market update. Clearly, things are evolving on a daily basis, and I felt it was probably more relevant just to talk as to what has this meant for infrastructure companies and for our portfolio today. So on the first slide there, just thought I'd touch on firstly and give everyone a bit of a macro perspective. We are bottom-up investors, but I think it's important to give that macro perspective. What started off as very much a China problem in January and the early part of February has very much now turned global. As we all know, we're seeing we've seen over 1 million cases of COVID-19 now. We've seen over 80,000 deaths, unfortunately, for this tragic event, and we're seeing many countries around the world move towards either lockdown or very, very strict social distancing measures. We know that the diagnosis has been challenging, but we also know that the recovery rate has been quite high. We know that the impact has tended to be more towards the elderly and also those who maybe have some kind of pre-existing condition. We also know that the world has in many ways been caught unprepared by this. It's created a crisis of confidence in many parts of the world. And you're seeing that play out, and the responses of countries has been varying, and everyone, every day, as I say, it's an evolving situation. Containment has been found to be effective, and we're seeing that roll out again in other parts of the world. China was the first to go essentially into complete lockdown, and it's a region that I follow very closely for our team in the portfolio. And the evidence that we're seeing out of China is that as they have moved out of lockdown, you are seeing that recovery come through now. Factories are reopening. Gas volumes, which took a hit, have already now started to turn positive. Toll roads, people are actually starting to get back on those roads, and if anything, you've actually seen volumes for toll roads even go up in the last week or two. Public transportation, such as buses and rail, continue to remain challenged, but you've actually seen people return back to normal there. So containment does work, but containment also means low activity, and in all likelihood, it also means recession. So on the back of all of this, government policy response is going to be critical. So that's just a bit of a macro overview as to where we're at today. If you look at the next slide, what has that meant for infrastructure? And the impact has varied. I've given you here a chart which shows 4 different companies within Italy and the impact that we've seen on volumes. So that chart there, firstly, electricity and gas. Turner and Snam are 2 regulated utilities in Italy. You can see volumes. So Turner being an electricity transmission company, Snam being a gas utility. Volumes have fallen around about 20%. But importantly, for a company like Turner, only around 10% of their revenue has volume risk. So even if you saw a 20% fall in volumes over the full year, that would have about a 2% impact on revenue. Those are regulated businesses, and that's important to remember. The impact for airports and toll roads, though, has clearly been more significant. You can see airports volumes at so FCO and CIA, that's the 2 Rome airports, are down. It's incredible what we're seeing. You know, airports are down, volumes are down almost 90% in the last week. Airports around the world are essentially closing their borders. We've seen it here in Sydney, we've seen it in Auckland, and international traffic has almost come to a standstill. Now, again, stepping back, do we think that this is a somewhat unique one-off shock? Yes. Do we know how long this is going to continue? No. But we do know that volumes will return, but you are going to see this one-off hit in the near term. On the next slide, you can see, you know, what has this meant to infrastructure performance year to date, and the charts here that we've given you are for the March quarter, which we've just come through. So for the first 3 months of the year, and you can see that it really does vary. Maybe starting at the bottom, as I just talked about, the sector that's been most directly impacted has been airports. Volumes for the quarter were down. In the last few weeks, as I mentioned, 90%, but the performance of the asset class, you can see share prices have fallen about 40% over the last, on average, for the quarter. They're the most susceptible to travel bans. We're seeing it play out now. We're going to probably see, in our view, it's very likely you will see major airline collapses come through. You'll probably see governments step in and bail out a lot of these airports. We're already hearing anecdotes of what might happen here in Australia with Virgin, even Qantas. And we know also that international traffic is the most profitable part for many of these airports. You know, for an airport like Sydney Airport, they earn a revenue every time a plane lands per passenger, on average about $35 when those passengers come in. And not only that, they're earning revenue then too when they come in and spend money on duty free. So this is going to clearly have an impact on earnings in the near term. We've been cautious as a team, airports for some time. Nobody anticipated an event like COVID-19, but we'd felt that valuations had got ahead of themselves. They were assuming that growth would continue for many, many years to come. And what we've known by managing and investing in portfolios such as this for such a long period of time is that they do have cyclical shocks at various times. So today we only have about 4% of the portfolio invested in airports. We've been underweight and cautious for some time, and we're just starting to increase that exposure again, as we've seen some of the quality infrastructure airport stocks in our universe get really hit, in our view, probably too far. But as I say, it is a cautious We are being cautious there. We do think that there's going to be bankruptcies. We do think that there's going to be, in the airline space, I should say, and we do think that there's going to be probably some more near-term bad news to come. The other sector that's been hit quite heavily has been pipelines. Clearly there was going to be a demand shock on the back of COVID-19, but now you've had a double whammy where you've had the Saudis and Russia also come to a head, and OPEC is essentially broken down. So you've got the double whammy of a demand shock, along with now a supply shock, where you're getting more and more oil getting pumped into the system, and you've seen oil prices collapse from $60 down to as low as $20 today. That's put pressure on not so much the earnings of the pipeline companies in the near term, but it's put pressure on the earnings of their customers, and it's put into question a lot of the future CapEx plans for some of these companies. So again, those have been really the two most sectors directly impacted, along with also toll roads. Toll roads, we've got 100 years of history to look at roads in Italy, in Europe, where you can see that road volumes have generally been very, very stable over a long period of time. But right now, when you shut down and lock down a country such as what we're seeing right now in Italy, clearly that's going to have an impact on volumes. So again, we think that this is a one-off shock. We think that the share price reaction to some of these companies has been overstated. And with share prices coming down 30–40% for some of these companies, we think that that's now well and truly reflected in the long-term value of these assets. On the positive side, I've talked about towers. They're a clear beneficiary of what's been going on. Share prices have actually stayed flat through this period. And utilities have, with their regulated earnings, some of them do have some volume exposure, but on the whole, their earnings are going to remain largely resilient through this one-off event, have also held up well in this environment. I won't touch on the regional exposures there and performances, but they've broadly held up as we would have expected. The UK kind of had a big hit prior with Brexit. Japan is seen as a safe haven in down markets, and it's done so. And the other markets have really performed as we would have expected. On the next slide, you can see our portfolio as today and what it looks like. I mentioned airports. Only about 4% of the portfolio invested in airports today. We remain underweight and cautious. If you look at our portfolio, probably the best way to think about it is about 60% of the portfolio is made up of utilities and towers. Those have continued to remain resilient through this event of COVID-19. The other 40%, which is what we would describe as being more growth infrastructure, where we're still very confident in that long-term structural growth story, clearly are taking a hit to earnings in the near term as this lockdown plays out. So toll roads, we've been overweight, and we've been invested in some of those companies around the world, companies like Transurban, like Atlantia, like Vinci. We think that today the share price reaction has been over and beyond what the actual long-term change to the value of those companies is. So if anything, we're even starting to top up some of our positions there. And on the right, you can see portfolio weights by region. About half the portfolio generally is made up of the US. The US is almost like 50 countries when it comes to infrastructure. Each state has its own regulator. There's often multiple utilities within each of those states. So it tends to make up about half of the portfolio today. On the next slide, you can see valuations, where they stand. We've been in a low interest rate environment. Valuations, as in most parts, in fact, all parts, I would argue, of the world in recent years have trended up, particularly within equity markets. But you can see now that that's really come back in the last, even just in the last few weeks. Price to earnings now are starting to trade at what are looking like really quite interesting levels. Now, admittedly, this is working on the assumption that those earnings continue to be resilient. We do think that there are going to be some earnings downgrades in some parts of our universe, particularly in the more growth orientated companies, the toll roads, the airports in particular. But that price to earnings now of around, even if it's not 15 times, call it 16 times, is starting to look very attractive again today. Again, remembering we're long-term investors, and this is somewhat a one-off unique shock that we're seeing to these long-duration assets. The chart on the right shows you valuations by subsector. Pipelines probably is the one that stands out. If you look at that chart there, you can see the dot which shows valuations today relative to their long-term range. At around 8 to 9 times, I'm not sure I believe that number. I'd say it's probably more 10 to 11 times. You're going to see some earning downgrades come through. But even once you factor those in, we think that valuations are starting to look very attractive today. On the next slide, you can see, just again as a reminder, as long-term investors, and we take a 3 to 5 year view when we invest in any company, we've been through these events before. Sydney airports, whether it was the pilot strike, the Gulf War, September 11. I was an airline and an airport analyst in London through September 11. In 2003, SARS. We've had the GFC. We've been through these major one-off shocks in the past. Yes, they can have an impact on near-term volumes and sometimes even earnings, but volumes do always recover, and we expect that to continue. Sydney Airport, with its 15 odd million passengers, those passengers will return. Now, do we know whether they're 3, 6, 12 or 18 months away? No, but we do know that those passengers will ultimately return. The chart on the right, UNP is a North American rail company. Even through it's one of the largest North American rail companies. They basically own the rail network from the Port of Los Angeles through to Chicago. They have one competitor in that market, and that's Warren Buffett, who is the owner of Burlington North. Even through the global financial crisis, you can see volumes for these rail companies fell by around as much as probably 20 to 25% through that period, for a couple of quarters there. But look at what happened to earnings, to EPS. They continued to grow. These are companies that are able to continue to increase their prices. They continue to strip out costs. Already, the rail companies have reduced their headcount by 15, even 20%. And debt levels for these North American rail companies are generally in very, very good shape. So we remain confident on that long-term growth story. And finally, just to touch on what does this all mean in terms of the outlook for the asset class? COVID-19 has created a lot of uncertainty globally, not just in markets, but frankly in everyone's lives. Listed infrastructure, it's a defensive asset class, but it is also still an equity, and we've seen that play out in the last few weeks. Transport stocks, energy have been the most susceptible in our universe. But that's been offset, or partially at least, largely offset by utilities and towers holding up in this environment. Today, we think valuations are looking more compelling than they have at, frankly, almost any time compared to probably going all the way back to the GFC. And you are really now starting to price in recessions in many instances. So at first, Sentier, what does that mean for us as a team? It means even more engagement with our companies. Yes, I'm not able. I was meant to be in Hong Kong this week meeting companies. Am I able to do that at the moment? No, but through technology, I've had calls with almost every one of my companies in the last week. It means calls with not just companies. It means calls with your regulators, competitors. So we're continuing. If anything, we're looking to increase that engagement with companies. As a team, it means even more stress analysis, looking at what's the robustness of this business model through not just structural, but now through cyclical downturns. What's the leverage of the company? We're running all sorts of scenarios on leverage, counterparty risk, particularly for airports and for energy pipeline companies, and how are management teams responding to this crisis. It's through times of crisis that leaders really come through and shine. If I look at the portfolio as a whole, I would say that there's been minimal changes. There have been some changes to the portfolio. I mentioned we started to increase our exposure to airports again, but on the whole, as long-term investors, I wouldn't want to overstate those changes. One observation I'd make is that there's been a bit of a high grading of the quality of the portfolio. We've found that quality has fallen along with some of the lower quality names, and that's given us an opportunity to maybe sell out of some of those lower quality names and reinvest back into the higher quality names in our universe. But on the whole, as long-term investors, we continue to manage the portfolio for the long term as we always have. With that, I think I've sort of hopefully covered off on the key points I wanted to touch on, and I'll pass it back to you, Toby.
Great. Look, thanks very much, Trent and Tim. So as I mentioned, if you have questions for Trent or Tim, fire them in on the Q&A. There are a couple that have come in already, and one of these is about inflation. I mean, do either of you have specific views on inflation and its direction? And if you do, how does that inform your view on the way infrastructure will perform? You guys are both on mute, so.
Trent, you might be better placed given you look at the individual companies and how they handle inflation, pass it through.
Sure. Look, inflation is something. I think it's a fair question to be asking right now. I'm not sure that it's going to necessarily be something that we see a big pickup in inflation anytime soon. As you know, inflation levels in most parts of the world are very low today. What I would say about infrastructure as an asset class is, as a general rule, inflation is a pass-through for the large majority of our companies. So if you're a utility, a regulated utility, the regulator allows you to pass through that uncontrollable cost through to the end customer, which is you and I as users of that gas, that electricity, that water. So inflation is a pass-through for most of our companies. But do I think that inflation, that the outlook for inflation is a pickup anytime soon? I'll be honest, it's probably hard to see. I think what we are going to see is a real pickup in leverage levels around the world. We are going to see household debt, corporate debt to an extent, but government debt in particular really pick up. And I think there's going to be a deleveraging phase for quite a few years here, and probably inflation stays low for a period of time.
Right. Okay. Now, obviously, one of the key issues for infrastructure assets over the last couple of weeks has been the whacking that some commentators have looked to give to the industry funds. So let's think about liquidity without talking about the industry funds. Listed markets provide liquidity through the vehicles that they hold. So do you have a view, and Tim, do you have a view on the assets held within the funds that you research as to directly held, less liquid versus the sort of listed vehicles that Trent specializes in?
Sure. So in terms of our universe of coverage, we focus exclusively on portfolios like Sentier, which are wholly invest in listed equity and listed infrastructure securities. That's been an explicit consideration from our side of things, because when it comes to liquidity and how you're able to package together, say, a portfolio of unlisted securities into a managed fund construct, where there may be daily pricing and daily dealing, there is obviously a clear potential for a mismatch of what investors are potentially seeking. I guess one of the factors there, and I guess our reticence for sort of covering more unlisted infrastructure portfolios, is that a big part of what is involved there is the sort of how you value those assets, how you get sort of independent and verifiable valuations. These portfolios typically have periodic valuations of those assets, and being able to sort of dig into how that's formulated and getting across that is certainly tricky from an external point of view. So we've always stuck to portfolios that focus only on listed securities. There are a couple of portfolios out there, managed funds out there that do invest in some unlisted infrastructure companies. I guess the important thing is always about, from an overall portfolio view, do these portfolios actually give you anything different to what you could otherwise find from a listed a portfolio of listed infrastructure securities, really understanding, is there sort of a genuinely different exposure that you're getting? Because otherwise, if people are just kind of attracted to the headline, potentially lower volatility that unlisted infrastructure company portfolios may provide, then maybe they're not fully considering all the risks and whether it's really suitable for what they want. So yeah, that's where our focuses lay, and yeah, that's kind of why we've chosen that path.
Trent, you touched a little on volatility, but I wonder if you talk a bit more about the degree to which the underlying stability of infrastructure assets is sort of detracted from by the volatility that equity characteristics of the market, give to the actual vehicles themselves.
Yeah, absolutely. Yeah, clearly it's, liquidity is not important really until you need it, and that's what we're sort of seeing at the moment here through this COVID event. So firstly, just touching on our portfolio as managers of listed infrastructure, these are very large, very liquid companies generally that you're investing in. It comes back to the very nature of what they are. They're large, capital-intensive businesses. The average market cap for our portfolio is around $35 billion US. So, being able to move in and out is generally, that liquidity is generally there. For us, obviously, valuations are done on a daily basis, so we have that immediate mark to market. Now, that can be a positive, but it can also be sometimes, there's pros and cons to that. And I spent many years working on the unlisted side as well. The positive is that we do have that daily liquidity. The negative is that sometimes markets do overreact, and sometimes they fail to appreciate that the underlying earnings for these companies are not changing that much. And probably if I come back to, even the airports and the toll roads as the best examples of that, this 30-40% volume shock that we've seen for even Transurban now in the last week or so here with toll road volumes, we're seeing that reflected in share price performances for some of these companies, which is basically saying they're extrapolating that this is going to continue on forever. We know that that's not the case, so we know that there's going to be, that volumes will return. There's pros and cons of both listed and unlisted, but for us as managers of a listed infrastructure portfolio, we have that daily liquidity. They're very large, very liquid companies we're investing in, and we've been able to manage the portfolio through this period accordingly.
What about now for an Australian investor, and this is Tim or Trent, for an Australian investor, the roles that the view they should have on domestic infrastructure versus Asian or global infrastructure?
I might start. I mean, there really aren't, in terms of the portfolios that are available for investment. There are very few that really don't have like a global remit. I mean, there are a couple of strategies that say have an emerging markets for slant, but in the main, most portfolios are global in nature, and that really comes down to the opportunity set. Like when we're talking about Australian infrastructure, Trent can probably step in here, but I mean, I can't think of more than high single-digit number of companies that actually are sort of infrastructure businesses. So how you're able to build like a diversified portfolio in that context is certainly going to be tricky, especially so you're going to have meaningful concentration risks. And when you have that degree of concentration, when things go wrong, which unfortunately sometimes they do, you're obviously going to be particularly susceptible to that. So it's the opportunity set that's really the reason for why global infrastructure has become what it has. As for whether Australia or Asia or wherever particular markets are favored at one point in time or another, there's obviously different characteristics in terms of the strength of the regulatory regime, the stability of the sovereign that may affect the risk attributes of a different infrastructure company. But in the main, we see globally diversified portfolios as being the most sensible way of getting exposure to the sector.
And Trent, from your point of view, your graph showed sort of 60% exposure to US and 40% to the rest. What are the things that drive your kind of market selection, or is that just not an issue?
I think Tim covered it well. The reality is when you look at our universe of companies, there's only probably 300 companies globally that could even fit into the broad definition of what is infrastructure. And within that 300, we screen that down to about half that number, screening out anything with too much volume, too much commodity risk, and so on. So it's not a large opportunity set. They're very large liquid businesses in their own right, but it's not a large opportunity set. So if you're going to invest in this space, you really do need to think global. For us, we build a portfolio from the bottom up. It's really looking at, for each business, the strength of the regulatory regime in that country or that jurisdiction that they operate in, the strength of the political system. We always say the number one risk when investing in infrastructure companies is the political and regulatory risk. And really just understanding the dynamics for each of those own businesses. So yeah, there's only a few opportunities here within Australia. We only have the 2 positions right now in our portfolio, and hence, it is very much a global portfolio that we're investing in.
All right. Look, final question, because I'm conscious of the time. So pensioners are quite stuck with cash interest rates being low, and the equity portfolio has taken a knock. Now, dividends are being slashed in some companies. What would you say to that? What would you say to an advisor to pensioner investors about the role of infrastructure funds or infrastructure assets in the sort of emerging portfolio structure?
Yeah, look, I'm happy to kick that off. Look, I think one of the key reasons why investors continue to look at infrastructure and real assets as a general rule is for that income. And for our portfolio today, if I look at what we're forecasting, we've got about a 4.4% dividend yield for the year, for the 12 months ahead. Now, some of those companies are probably within our portfolio. The 45 companies are probably going to see a dividend cut, and we've already seen a couple of those play out. But based on our best case estimates, you might see a 10% cut to that overall dividend. So that 4.4% dividend yield might trend down to 3.5%, 4%. So in a global context where you're seeing dividends being cut all over the world in all different sectors, and with interest rates at near zero, we think that dividend or that income yield of around 3.5% to 4% will continue to be, in fact, may even prove to be even more attractive going forward.
All right. Look, Tim, Trent, thank you very much for your time today. Infrastructure is an area of high interest, and certainly one which is going to be a structural part of portfolios going forward. So to all of those of you who've attended today's webinar, thanks very much. A reminder that the Advisor Roadshow will be held from the 20th to the 24th of April, focused on professionalisation, and the next of these webinar series on the 29th of April with Lonsec on alternatives. So thanks very much, guys, and I'll look forward to seeing all of you again at our next session. Thanks.